Well, good morning, ladies and gentlemen, and welcome to our Retirement System Investment Commission meeting of February 25th, 2016. First order of business is to, we have a consent agenda. Do we have to do anything on that?
Just a motion to adopt the agenda.
All right, then we have an adoption of the proposed agenda. Want to read the motion?
Oh, just a motion to adopt the agenda as presented.
Do you have a
So moved.
second? Okay, motion has been approved. Do we have a vote?
It's
All in favor, say aye.
Aye.
Aye. Any opposed?
Aye.
Okay, none opposed. Motion is carried. Okay. Secondly is the chairman's report, and we simply have a reminder about filing statements of economic interest by March 30th, 2016 at noon. And you should have received an email from Brian Wheeler with a link and filing instructions, so be sure to accomplish that by March 30. Next is the CEO's report. Mr. Hitchcock.
Thank you, Mr. Chairman. Mr. Chairman, I know last year we're kind of getting into the mode where we're planning for our two-day June meeting. Last year we did it here in Columbia on a Thursday and Friday. Had a two-day meeting here in Columbia. What I wanted to do was just really kind of seek the guidance on the commission if they're more in favor of doing it in Columbia, or if you would like to go back to Wampee. If we would go back to Wampee, Wampee is not available that Thursday and Friday that we have already scheduled. It is available, however, the Monday and Tuesday after that. So the June 20th and 21st, that Monday and Tuesday. Just wanted to kind of give you an opportunity to give the commission an opportunity to weigh in on that. I don't think we necessarily have to make it. We've got it. We've had Wampee on hold just in case that the commission would desire to go back to Wampee. We have it on hold for those dates at no cost to us. But we'd probably just need to let them know as soon as possible, or as soon as we can, as to whether or not we want to go, or if the will of the commission is to keep it in Columbia, we can do that as well. And we can do that on the regular dates of the meeting that we already have scheduled. So.
Don't we save money by having it here? Or no?
Yes, we do save. I mean, there's some costs associated with going to Wampee. So.
Do you want a decision now? If people are willing to.
If people want to maybe check their schedules and just let Tricia or I know, maybe within the next week, that'd be great.
Does anybody have any strong feelings one way or the other? As far as I'm concerned, last year's meeting here in Columbia was just fine. I see no reason to go to Wampee unless people feel strongly about that. But you want to let people let you know in the next 10 days or so?
Maybe by the end of next week would be
By
great.
the end of next week, please let Mike know if you desire to have the meeting here in Columbia, or you want to go to Wampee, or whatever your schedule accommodates.
Yeah, and I just didn't know if there was a strong magnetic desire to return to Panopolis, to the vast metropolis of Panopolis. So, I would like to take a moment to, we've had some new staff that we've added, I think, since the last time that we really had a full regularly scheduled commission meeting. So I would like to take a moment to introduce some folks that you may have seen at the last meeting, but we didn't really, given the limited nature of that, we didn't really have an opportunity to introduce. So start out with Greg Cowell, if you'll stand. Greg is taking over for Corleone in our IT department. We have Lynn LeSueur. She is our new ODD officer. We have Chris Raddick, who is a new member of our reporting team. And we also have Lisa Scott, who is our new administrative support analyst and receptionist. So we also have Kim Cornell, who I believe many of you met at the last meeting. She's unable to be with us today. She has a doctor's appointment. But she is our new paralegal. So just wanted to take a moment to introduce all of our new folks to you. Also wanted to give you an update on the executive search firm RFP. We are now at the point where last week we sent, I guess, our final revised RFP to procurement. They'll need about 2 weeks to review and finalize. They anticipate that the RFP will be posted for the search firm the week of March 7th. I know that we had had some discussions, and we made some amendments to the governance policy in regards to my role in helping in the, developing the plan to search for the CIO. But I think that there is one point of clarification still in the governance policy. The commission has a executive search firm like this would be a named service provider. Given that we're not going to meet again until April the 21st, or I would just ask that you delegate to me the ability to select the executive search firm so that we can go ahead and get that search firm under contract and go ahead and get the search finally started. So I am asking, and there is a motion to that effect, whenever you would want me to read it, Mr. Chairman. Motion would be the commission delegates to the CEO the commission's authority under governance policy 8B1 to approve the appointment of an executive search firm to be identified through an RFP process conducted in conjunction with MMO as part of the CIO recruitment plan approved by the commission on November the 19th, 2015.
Motion to approve.
So moved.
Second? Any discussion?
I would just ask that.
Mr. Chairman, I would just say one thing. I was doing a little bit of reading about this, and it was interesting, and I won't go into a long one because it's just kind of a nod toward Mike. If you can, there seems to be a great disparity between the large firms and the small firms and the cookie cutter and the specialized services. And the more I think about South Carolina, public fund, we're hiring at a time when salaries are going to be questioned no matter what you pay. I think that if Mike could just have a particular sensitivity to perhaps a smaller firm that can work outside of a large international or national firm, we might find a different and more appropriate panel of candidates. And so that's all I have to say. I'm for
Sure.
the motion, and I'm sure Mike will do a fine job with it.
Yes.
Well, yes, I think that's a good point, and we want to be particularly sensitive to fees generally, and we'll certainly ask Mike to pay particular attention to this particular set of fees.
And I would just ask
Anything else?
that Mike keep us updated on the types of firms that are responding to the RFP as well as their fees so that we are kept abreast of that. You know, I'm a firm believer that this is one of the most important decisions that we will make, you know, albeit we'll make it through Mike, but I think that making sure that we have the right CO, and, you know, no disrespect to Jeff because I think he's doing a great job, but I think through the search process, you know, we should be making sure that whoever we hire, whether it's Jeff or someone else, that they have, you know, the right skill sets and the right experience to take South Carolina forward. And I'd like to make sure that, you know, in evaluating the search firms, we keep that in mind.
And, Mr. Chairman, certainly we'll do that. And as well, we have in the interim, we do have a HRC meeting that's scheduled, so I will also make sure that I'm specifically keeping the HRC committee up to date on that as well. So, and make a presentation to them at the next HRC meeting as well.
Any further discussion? If not, all those in favor of the motion signify by saying aye. Aye. Opposed? None. The motion is carried.
Before we get into the Iran-Sudan divestment policy, just have one other update for the commission, given that it's timely. The House Ways and Means Committee finished their work on the appropriations bill, their version of the appropriations bill last night. Our budget request was granted by the House Ways and Means Committee. So, and basically just to remind the commission, we're asking for a budget authorization of basically the same amount that we had for this fiscal year minus $500,000 in our personal services budget. So that request was approved by, and the same number of FTEs. We're not asking for any additional FTEs. So that request was approved by the House Ways and Means Committee. Budget will move on to the full House. We had our Senate Budget Subcommittee meeting yesterday, and I think that that went well. But I just wanted to give the committee an update on, or commission an update on that. And pending any questions in regards to that, I think we'll move into a presentation on the Sudan-Iran divestment policy, and Mr. Goldsmith will be leading us through that discussion.
Should we have people sit today, since we have so many people on the phone?
Sure, yeah, Yeah, I think that, Mitchell, if that's okay, I think that'd be good, yeah.
Well, thank you, Mike, and thank you, Mr. Chairman. I just want to thank everyone on staff who's helped in the development of these policies. They've been quite a ways coming. When Mike asked me to make this presentation, I reminded him that I started my career as a litigator, but I'm no longer one, so hopefully you will all bear with me this morning. But we are presenting these policies this morning for informational purposes. We're not asking the commission to take any kind of specific action today. We just want to walk through the laws, the policies staff has come up with at this point, and basically determine whether the commission thinks we're moving in the right way or if we need to reevaluate. So with that, we'll start with a brief overview of the laws. I know some of you are already aware of these, they're on the books, but just giving a little bit of background. I think most of us know that divestment is the sale of an asset for financial, legal, or philosophical reasons. The purpose of it is really to affect behavior of a political entity, change corporate behavior, and generally avoid profiting from activities that are generally done by bad actors. Some examples some of us may remember was U.S. divestment of assets in South Africa during apartheid. And today, a lot of us hear about ESG initiatives, environmental and social governance. Certain investors, universities, endowments are divesting from assets in tobacco companies and fossil fuels because they believe those activities are harmful in general, and supporting those corporations is not proper. Turning to South Carolina's laws particularly, the Sudan Divestment Act of 2008 has been on the books for a while. Some of you may be asking yourselves, why is staff bringing this to you now? This sort of predates my role at the commission, but originally we didn't believe that we had much exposure to this, to assets that are corporations doing business in Sudan. So initially, we didn't really develop policies, but as the commission has diversified its portfolio and exposure has gone more international, we saw a real opportunity to bring this forward, along with the passage of South Carolina's Iran Divestment Act. It really made sense to address both of these in tandem. The Sudan Divestment Act particularly is based on 2007 legislation, the Darfur Accountability and Divestment Act of 2007, and it was a response to the mass genocide that I'm sure everyone in this room has read about in Sudan. It left 400,000 dead, along with 2.7 million displaced people. And you may have not seen it in the headlines recently, but there have been increases in violence, so this is very much a real conflict that has been going on from 2003 to today. In terms of the Iran Divestment Act, I think a lot of you have probably seen this in the news recently with the lifting of some sanctions. It's important to note at this point that the sanctions that have been lifted do not impact South Carolina's Iran divestment law, and even if the federal government decided to lift those sanctions, South Carolina, many of our public officials have pledged to keep these sanctions in place. So it is something we do need to keep in mind and consider as we talk about these policies. And that legislation was really based on 2010 federal legislation designed to target Iran's development of nuclear energy. Basically, it was designed to discourage that and prevent them from obtaining nuclear weapons. And now delving into each law in turn, I think it's very important to understand these laws are very similar in their purpose and what they do, but they do apply a little bit differently to the commission. The Sudan law basically applies to the commission only to the commission. So this is really our law, and it impacts a broad range of companies in the oil, energy, and power sectors of Sudan. And of course, it also applies to any companies providing military arms to the government in Khartoum, Sudan. So generally, this is designed to discourage the government in Sudan from continuing their many-year genocide in the Darfur region. This was a Funston recommendation that we take up, this particular issue, and because we don't have a Sudan divestment list provided by the state, we've contracted with a vendor, IW Financial, which is the same provider that provides the State Fiscal Accountability Authority with their Iran list, and they've been helping us through the process. And the purpose for getting that service provider in place was really, we didn't know what our exposure was to this particular securities. So we needed to get a company in place that could help us determine that so that we would know what we were actually looking at. And we've done some preliminary work. We didn't want to do too much before we got the commission's approval on how we should move forward. And they're assisting us with just implementing processes, procedures, et cetera. And they're a very well-known, nationally recognized firm helping us through that. The Iran Divestment Act is a little bit different. It applies to all state agencies and political subdivisions, and it's got two parts. It prohibits investments by the commission as well as the state treasurer's office in companies, or potentially even going down to the individual level, who do business in Iran, and companies that have, and then prevents state agencies from contracting with companies who also do business in Iran. It's got a focus on the energy sector. Iran has obviously a oil industry, but this law is really targeted at reducing and very targeting that industry so that some pressure is felt to bear. And as I noted earlier, some of the recent removal of sanctions will not impact South Carolina's Iran divestment law. So again, this is something that is very topical and very current. The nice thing about this particular law is the State Fiscal Accountability Authority has developed a list of impacted securities so that we can actually rely on that list to do most of the legwork for us. The one thing I do want to highlight, and I think it's very important that we recognize, that we do have very important exceptions to both of these laws. The investment exception is the first, and I think it's important because these laws do not apply to what the General Assembly has called indirect beneficial ownership, which means investing through index funds, commingled funds, limited partnerships, derivative instruments, and the like. Basically, the General Assembly wasn't telling us we need to divest assets where we've hired a manager who has skill and we want them to make decisions for us. And we can't necessarily control each of those decisions, nor do we want to, but they've basically exempted us from having to cover any of those assets. The other exception, which I think is also very important, is the fiduciary exception, which basically says, and both laws provide this, that the commission is not required to take action unless divestment is determined in good faith to be consistent with the fiduciary responsibilities of the commission and there are appropriated funds of the state to actually take that action. So in this instance, if we were to decide we needed to divest of a particular asset, we already held it on the books, the value had gone down, we could hold that asset for a long period of time to see if the value went back up so that there would be minimal impact to the plan. So with those two exceptions kind of in mind, really this law applies to our separately managed accounts and our accounts that we trade internally. Now, I'm going to talk a little bit about the recommendations that staff has come up with. We have worked very closely with some of our brother and sister pension funds around the country, including North Carolina, New Jersey, and Florida, in order to basically get an idea of what their approaches have been, because many other pension funds, as I said earlier, have already divested from these assets. So we think we've struck a good balance. So what staff is recommending is two parts. As we discussed, the Sudan and Iran law both have investment decisions. So the idea that we came up with was basically to prevent managers from acquiring securities of companies whose activities are covered under the law. So going forward, we can screen off any assets that come up on the list. In addition, we delegate authority to the CIO to sell impacted securities as it's deemed prudent. Again, that's going back to the idea of looking at the current portfolio. What do we have that's impacted? Does it make sense at the plan level to get rid of it? And then the Iran law relative to the procurement piece, the contracting piece of that law, delegating authority to the CEO to cancel contracts with vendors whose activities are covered under the law. So basically, in the future, we would screen investments as well as contracts for Sudan and Iran affected activities, and then we could screen and basically making a determination to whether we need to sell an investment or we need to cancel a contract. And of course, we want the commission to be well apprised of this, so the CIO and the CEO would report to the commission annually about all actions taken under either of these policies. And both of the policies, I believe, are in your packet. We just want the commission to be aware that these laws are on the books, that we staff has come up with a couple of policies in order to address them, to make sure that we are in fact complying with state law. And at this point, I'll just pause and ask if there are any questions by the commissioners, just to better understand what we've presented here today.
Hey, this is Curtis. But thanks for the thorough, report, and I really appreciate it, and especially the honesty, the highs and the lows. Of course, it strikes me that a small part of our portfolio is affected by this, and probably 80% of it's not. Do we look out for, I'm making this up, this is in the pretend world, that there's a hedge fund called I Invest in Iran because nobody else can, hedge fund. Do we look out for people who do tremendous business in Iran? Maybe it's the focal point, but we're involved because it's a commingled fund or a manager. Or do we make those kind of extraordinary searches?
Well, Mr. Treasurer, if I think I understand your question. In general, I will say this ship sailed a little bit. Most hedge funds, actually a lot of our managers already screen off a lot of these assets that would be impacted by these kinds of laws, simply because they're doing it for other pension plans, other investors, just because it makes sense. In terms of internally tracking that kind of activity, I think I would have to defer to Jeff or Mike on that one. I'm not sure that we're doing that currently.
Okay, I don't know how practical it is, but I just throw it out there. I'm glad to know that a lot of people have already screened those things out of the portfolio. But, if I were a hedge fund manager, one of the things I think about is I want to go where there's a vacuum of capital. And I just didn't want us to be heavily invested in somebody who only does business there. But I think that y'all have the spirit of the law, and I'm very confident with what y'all doing. Just throw that out there.
And Mr. Treasurer, to your concern, many investment managers are already prohibited under federal law from doing business with Iran. So the isolation that the federal government and state governments have intended has had a very real impact on their economy. So I think you'll see, if we actually did search, I think you'll see that if there is activity in Iran, it's going to be very limited, and it's not going to be usually by U.S. based managers.
Yeah, I would assume it's European partners and people like that.
Yes, sir.
Again, thanks, Mike. I'll go back on you. Thank you very much.
Yes, sir.
What's our best estimate of the dollar amount we might have out there that relate to this sort of thing?
Well, with dollar amounts, Mr. Williams, I can't tell you specific dollar amounts. It does fluctuate. Obviously, it fluctuates every day. I can tell you that when we ran the initial search, we had 15 securities that were impacted for Sudan, and we had about 26 for Iran. So it is a very, very small portion of the portfolio. And like I said earlier, most of our managers are screening off a lot of these assets anyway, because it's more trouble than it's worth, quite honestly.
Well, I'm thinking the whole thing's more trouble than it's worth. So that's what, are we fluctuating between 0 and 100,000, or between 2 million and 10 million?
I would, this is nothing but a guess, but I think we're talking about a fraction of 1% of the portfolio overall. I mean, I would be surprised if it was more than a total exposure of $20 million, but.
When the law was first passed, the part about we didn't have to take action unless there were specific appropriated funds to do it, I immediately put that in the back of my mind, because I knew that never appropriated any funds. But it sounds like IW Financial, have they appropriated funds for us to pay IW Financial?
Specifically, the legislature has not appropriated direct funds to say, go out and pay for this divestment list company. We initially hired the vendor basically to see what the kind of exposure was, because frankly we didn't know. And going forward, depending on how the commission determines we should take action, we can obviously cancel that contract at any time.
What's the dollar level of that contract?
I believe it's $7,500 a year, and then the important thing to realize is with a lot of this work, it's front-loaded, because if you screen off all assets going forward and say our managers are not going to invest in Sudan, Iran, That's just a compliance function that we take, making sure the managers are staying in compliance. The work is on the front end where you look at the current portfolio, see what assets you have that are impacted, and then start weeding those out over time as it makes sense. We don't want to incur a bunch of costs to get rid of something just because we hold it. We want to make sure that we're doing that in a very responsible way at an appropriate time.
Any chance of getting the State Fiscal Accountability Authority to, while they're looking at Iran things, for them to look at Sudan things and let them do that list?
I'm not sure about, I have not requested that yet, but my guess is as busy as those folks are, probably, my guess would be no. I don't want to speak for them. But yeah, we are using the same vendor. We're following the same approach the State Fiscal Accountability Authority took. And like I said, with the recommendations staff has made, these really are congruent with what most pension plans are doing. It's usually a decision that's delegated to the CIO, CEO level, just because it's impractical. It would probably be impractical for the commission to make each determination one by one. Yes, sir.
Do you mind? Any other questions? So has IW Financial already provided us with done a screening and provided us with a list of everything in the portfolio?
They've done a preliminary screening. The important thing to realize about this process is it's designed to kind of be interactive with the company. Basically, IW is fundamentally a research firm. So they go out and look at public filings, they look at news reports, they develop a list of companies they think are subject to our specific laws, and then they engage that company and basically say, send out a letter, we believe you are impacted by this law, please provide us with an explanation. And then over a series of about 90 days, they have an opportunity to dispute inclusion. The ultimate decision would be made by the CEO or CIO, as the case may be. We have had them do an initial screen. We did not contact any companies. We didn't think that was appropriate until the commission had weighed in on this. So we don't have an official list. We have, I guess, what you basically say is an unofficial list for Sudan. For Iran, we do have the state's list, and we would likewise need to contact, if we think we have a security that's impacted, we still need to contact that company and make sure that it's not another subsidiary, there's not, some naming discrepancy or something to that effect. Hope that answers your question.
Any other questions? Jeff's presentation was really just for informational purposes today, so we're not going to ask for a vote unless people decide they're comfortable with it today. If that's not the case, then we'll present it for a vote in April. Nothing further on that?
Nothing further.
Okay, then we'll move on to the acting CIO's report. Jeff?
All right, I'm going to go very quickly today. I don't have a whole lot. Let me get through the policy. James, can you hit control there? Thank you. Appreciate it. So I'm just going to hit a small list of topics today, and I'm going to do this as efficiently as I can. First on the list is the notion of asset allocation ranges and benchmarks. When we voted earlier this month to establish the target asset allocation, aside from that, one of the other things that winds up in the SIOP are the allowable ranges as well as the benchmarks. We are looking at different alternatives for the benchmarks, the ranges. We're working with HEK on both accounts to try to bring some ideas that make sense in April. We don't have anything today, so that's very, very short. I'm going to move efficiently through the other elements here. You may recall back in November when we brought the kind of the first wave of summaries regarding the project wherein we're challenging our beliefs on an array of different investment matters. One of those that we just weren't able to achieve any consensus on related to the foreign currency risk in the portfolio. There's no recommendation today, but I want to just talk through how we're continuing to address this. By way of background, we saw the sharpest dollar rally in 31 years in fiscal 2015. It was a very painful experience. for anyone who owned non-U.S. assets. And of course, we have a healthy amount of non-U.S. equity as well as fixed income. So what happens is two things. One is an immediate effect, and then one is a follow-on effect. First, it effectively devalues a dollar that is invested in non-U.S. Securities, and because of the magnitude of this decline, it was an alarming, again, once again, it was once in the last 31 years we've seen it that steep over that period of time. The follow-on effect over time is that it actually serves to make the U.S. companies that seek to export goods and services less competitive, right? Because what has been devalued is now more competitive, and what has grown expensive is now less competitive. So this is just something that we want to make sure that we're not, we just didn't fight to a tie and then we go home. We're continuing to make this a priority, and I just want to make sure that I communicate this to the commission. So we're proceeding here in a way that I think is a little bit unique. Even though it is not an asset class, we're going to treat currency like an asset class. And I've asked our risk management team, specifically Wei Yi Ning, to spearhead the effort in this regard. We're going to work to establish a reporting framework on currency so that we can discuss what was the impact of currency on both our portfolio and the benchmark. So applying a little bit more of a rigorous framework to this going forward. But in her work and in that team's work, I fully expect we'll identify some discrete approaches toward managing this currency risk. I don't like the notion of, I think I mentioned this in November, of addressing the risk that just hurt us because it just hurt us. This is really a forever type project, I think, where we need to identify exactly what that risk is and consider whether or not we think that risk will yield a positive return for us or not. To that end, before I move on, we are going to continue to think about active management of currency risk as something that maybe that's the solution for us. Maybe the solution is we continue to wear the currency risk. We recognize we only have that event once every 31 years. Or maybe we decide to get rid of that risk entirely. And then that's a huge project in and of itself. So I just want to make sure that we're communicating, even though we, to continue the analogy, we fought to a tie in November, we're not giving up. We're going to keep going on this topic because it is something that we do need to have a mature approach toward. We're going to do this slightly out of order. I apologize, but
Excuse me, Jeff. Are you going to continue on in currency, or is this?
no, the current.
Could I just want to
Absolutely.
ask a comment, make a question on currencies. It seems to me that we saw this dramatic impact of currencies last year. Whether that'll be repeated again, nobody knows. But it seems to me there are two aspects to the currency challenge. Number one, we saw currencies impacted dramatically by moves in commodities, which differentiated from another movement, which was dictated more politically or economically by central banks. And Chinese even today are still moving towards further devaluations, which impacts other currencies as well. So it seems to me that the program that you're putting into effect is a very good one. It just seems to me that at some point, to avoid, say, another 31% hit or greater because of political considerations that are far beyond our control, that we have to have some basis for minimizing that. And I'm thinking, like, if we start to get a movement downward or adversely affecting us currency-wise, we have to have a mechanism that rather than watching it and studying it as it tumbles further and further and further, that we have a mechanism, whatever that we choose to decide, whether it's a percentage, and I'm thinking like what I would think normally in terms of equities or other assets, where if we have a decline of 7 to 8%, that immediately makes us decide, do we feel that we're comfortable with that kind of decline and it's going to be halted or will be minimized, or are we in danger of seeing a substantial further decline? So I think but I think what you've described should cover that.
Yes. Well, if what we're talking about is a process, really, that will take some time. So if that decline starts tomorrow, we're not necessarily ready for that with a fully robust, currency risk management approach. Now, let me editorialize here for just a moment. Normally, if you look back, and last year we looked back, I believe it was over 48 or 49 years of how does currency tend to interact with markets. And what we found was not all the time, but the overwhelming majority of the time, when global equities are down, that engenders this flight to quality, right? And flight to quality, in the U.S., for a U.S. investor, that means you sell stocks, you buy bonds, right? That's the classical version. But globally, what that means is people begin to develop a preference for the dollar, right? So normally, when what's happened over the last, 60 days happens, you would expect to see dollar appreciation if all you're doing is just kind of going by the numbers. We didn't see that, right? So maybe we've reached that point where it moved so far that we've got to move, right? So what's happened recently is actually the dollar strengthened modestly, since the doldrums of mid-year last year has been strengthening moderately against the euro. I'm not equipped to answer against the yen, but you just haven't seen what you would expect to see during a period of equity market stress. So that causes me to say, well, maybe it was such a big move that it has made its move, right? But that's not to say it certainly couldn't go further. So what we saw was a steep move over a very steep move over a very short period of time for currency, right? Currencies have made bigger moves. The dollar's made a bigger move of appreciation, and I think I hope I'm not getting this wrong, but I think we're talking about a 6-year move that in the dollar that was maybe 2 to 3 times the magnitude of this, and it culminated shortly after the Volcker Fed started taking action in the 80s, right? So there's a very long period of movement that you could see, and that certainly is not appetizing to us, to have the dollar strengthened by another 30 to 40%. But if my fear is that we take an action here, having felt the full force of the pain, and miss the kind of the return to the mean. So that's there's always 2 sides to a market. That's the fear that I have, is after going through the full pain, it would be almost as if during the financial crisis you decided you no longer had any taste for equities, right? Now you would have missed a 3x recovery. So I'm not giving a whole lot of great feedback to you, but there is the other side of it too.
I think what you've outlined is a process.
Yeah.
And I think that's the important thing, as opposed to simply reacting to a extraordinarily negative scenario.
And we have some impressive horsepower internally with which to do that, and we will certainly bring that to bear. Let me, on the agenda, we were going to get into the performance. What I'd like to do is just introduce the AIP, and then if we can go to performance after that, prior to the investment recommendations, if it's acceptable. What we are doing here today is simply introducing a draft AIP for your consideration. And what we would like to have, very much like to have, is your feedback regarding the priorities that we highlight. If there are additional priorities, we would love to have the benefit of your input so that we can consider these. Our tradition is to submit this for your review, not for a vote. In the materials, it starts on page 80. So again, we're not seeking approval. To the contrary, simply we would like to mark this as the opportunity to open the door for discussion with anyone who has concerns about anything we've outlined. I'll review the big picture items in just a moment. So if we could get your feedback prior to March 24th, that would give us time to work with the document and get it back to you well in advance of the April meeting, so that we can, move at that point. It does need to be adopted by statute by May 1st. But we're talking about the document that would not go into effect until July 1st of this year. So let me briefly review some of the initiatives that we're including. Obviously, the challenging beliefs exercise is getting into the marrow of the organization, so we do plan to continue to challenge our thinking routinely on an array of investment topics. We're not going to be able to keep doing this at the same pace at which we've started, but I expect we'll be discussing output from this at meetings for a very long time to come. Obviously, the second item, since we've adopted a new asset allocation, will become effective July 1. And not only that, but we've identified a glide path, a 3-year glide path for that. There are a number of implementation goals that will relate to this that we'll certainly need to execute on. Next thing on the list, I'm actually quite excited about. We've been working, and Brian Moore is really the champion of this project. We've been creating a quantitative approach that helps us with the determination of which asset classes are appropriate for active management and which are more appropriate for a passive indexing approach. When we get this to the finish line, we will be very eager to share that with you. When Brian presents in a few minutes, some of what he'll share with you comes out of the work of this project, and I'm excited about it. And I think Brian and his team have done a very good job with this. As I mentioned at the last meeting, we've been aggressively rebalancing for the last 5 months with discipline. We're looking at different ways that we can employ that same discipline. Also, we're looking at tactical asset allocation decisions, how we make them, how we ask ourselves the difficult questions about adding value through tactical asset allocation. And there's a lot of work to be done there. The strategic partnerships, we've discussed this before. We need to have kind of an ongoing ability to assess those partnerships to give you good information so that you can understand whether or not each of these is achieving its mission, and how do we hold these things up against more traditional approach to implementation. So we need to make sure that we're giving you that visibility, but internally we also need to be asking the difficult questions about whether or not those are worth it. Believe it or not, they are a good bit of work for the staff, and that only makes sense if there's a payoff for the portfolio at the end of the day. Risk management, we're working toward implementation of the risk system, and we'll continue to make progress toward that goal. Then the last two items, when I think about the cost of our portfolio, I come out of a corporate M&A background, so I think about everything in terms of fixed and variable cost. what we need to do is take a look at the cost structure of the plan. I would argue from that perspective. We have management fee, we have performance fee. We need to ask ourselves questions about the cost structure of the plan and what we might be able to do to make changes there. So that's something I think is something that should never sunset for us. And then finally, this annual strategic review, if you've gone through the draft AIP, you know what I'm referring to here. We'd like to host an annual strategic review concurrent with a commission meeting where we look in depth at a number of key issues, asset allocation matters, risks, portfolio themes, topics that are important to you or important to us, that we can think long-term strategically about, set goals about, and then mark progress toward those goals. So it's not a terribly ambitious thing to say we want to do. I think it's more ambitious to think about how do we come together, think strategically, and set those priorities. Aside from those are sort of the umbrella across the plan initiatives. Inside the AIP, I don't want to go on for an hour here, but there are goals that relate to implementation of each asset class, and I'm not going to spend time there, but I would encourage you to read those and offer us. I mean, we really do want feedback, so whatever strikes you, please, we want to make sure that the communication lines are open so that we can adapt and think differently about what we're putting out here in the AIP. So, are there any questions before we move on? Okay, so I'm going to invite Josh Green to come to the table. We'll get a microphone for him so people on the phone can hear. And he's going to give us the performance update through December 31st.
All right, it's good to see everybody again and hear those on the phone. I want to take an approach to this presentation in two ways. Number one, to talk about how we have made an effort to add value to the plan and how those efforts have played out. And number two, really taking a look at material changes in the plan that have happened since the last time we've met and just generally over the course of the fiscal year. We're going to start by talking about the forest and then moving into the details, or trees, if you will. First, just looking at asset classes that we invest in over time. The last 10 years, or once this fiscal year will be completed, 10 years. And annually those asset classes. The yellow is our plan return. And what this really tries to portray is the advantage of having a diversified plan over time, because while we would like to be at the top of this list of asset classes, you can't do that without the risk of being at the bottom, which is something that we don't want to risk. So having a diversified plan has landed us really in the middle and gaining really a median of all these asset classes that we invest in. Next, when it comes to our broad benchmark returns for each asset class, you can see our policy benchmark for the fiscal year ending 12/31, so a mid-year point, was down 3.1%. And as you go asset class by asset class, you can see why. Real estate led the charge, and I think that has been the case every time that we've met together since I've been giving this presentation. As you look down the line for real estate, you can see the 1, 3, and 5 year are actually our highest performing asset class in each case as well. And that's something that we're going to be talking more about later in the presentation. For this specific quarter, as you can see, global public equity had a very strong quarter from September until December. The S&P 500, every sector was positive except for energy. So a very strong showing from the U.S. markets, which didn't completely make up the ground from the overall losses. The U.S. markets were positive for the fiscal year. The international developed markets were negative 6%, and the emerging markets for the fiscal year had a negative 17% performance, which all rolls up into those weightings into the negative 4.9% fiscal year return that you see here. As far as fixed income markets go, it would look like a relatively tame and muted session. If you took a snapshot of point A, which would be 7.1, and then a snapshot of point B, which is 12.31, but yields started at 12.4% for the 10-year Treasury, sank below 2%, and then moved up to 2.3%. So looks like an overall session, but you really saw a flight to quality in the middle of the fiscal year, which was reflected in equities as well. Now when you get to our actual plan performance, you can see that on a fiscal year basis, we're outperforming by 21 basis points. Our plan return having a negative 2.93%, our policy benchmark returning 3.14%. Again, looking at the midpoint of the fiscal year, we are halfway through our usual $1.1 billion in net benefit payments, net of contributions to the plan. Our asset classes look very similar to those benchmark returns, with a couple of differences that we'll highlight in the next slide. But real estate, private equity, and core fixed income leading the charge, with our risk assets, global public equity, mixed credit, and commodities being the worst performers in a volatile session. Next, combining those two slides, the policy benchmark performance as well as our asset class performance. What you have is really the difference in those two. Private equity outperforming substantially and being shielded from the global volatility that we've seen. Hedge funds outperforming as they have consistently. And then on the other side, mixed credit, GTAA, and private debt underperforming for the fiscal year to date. And we'll talk about the impact that this underperformance had in the next slide. So moving from overall absolute performance to attribution, we've talked about this a number of times. The total value add column, which is the first column on the left, if you sum up those, you get our total value add, which is the 21 basis points of excess return. The allocation effect, a way to look at it is if you were passively invested in all of our policy benchmarks, which isn't possible because some of the private markets ones, but if you were passively invested in all of the policy benchmarks and just experienced excess returns from our over and underweights, our excess return would be the allocation effect here, which you see is negative 22 basis points for the fiscal year. Again, on the other hand, if we were perfectly at weight for all of our policy targets and just relied on manager selection or investment selection for excess returns, you would get the 42 basis points that you see in the total selection effect. When you combine those together, you get the total value add, or our 21 basis point outperformance for the fiscal year. Really, the movers are private equity and hedge funds and their implementation, really performing strongly against their policy benchmarks. Some of our detractors in the allocation effect are real estate and private debt. That's another kind of long-running theme that we've had is a overall underweight to our strongest performing asset class, real estate. And it's really a byproduct of investing in great managers and getting distributions back at a faster pace than we can really put money to work. So kind of a catch-22, but one that we have addressed over the course of the fiscal year. This is just a graphic representing the data that we just discussed. As you can see, largely driven by manager outperformance and underperformance. The allocation effect, which is the dark blue box, has a muted effect on the portfolio, whereas our excess return is really driven by the skill of our managers. Now, when you take that same data and look at it from a dollar basis, you can see the dollar impact. Now, if you had invested perfectly at weight and perfectly receiving policy benchmark returns, then you would see the policy ending value, which is the left dark blue bar, so $27.7 billion. And then you can see the dollar impact, the shaded boxes being the impact of the selection effect, the solid boxes being the impact of the allocation effect, until you get to the $27.8 billion actual ending value. So overall, a $63 million impact, which is rather muted. But really seeing the steps that it took to get there, I believe gives a little insight into really the impact that each asset class can have on that number. So next, just highlighting how we've gotten from our beginning fiscal year value to now. You see the $533 million impact that net benefit payments have had, as well as that 2.9% negative return showing up in our investment performance, which has had a $859 million detraction from our beginning plan NAV. And that's led us to our $27.8 billion, $27.8 billion ending value that we're at as of December 31st. Now that we've talked about our process and really ways that we tried to add value, looking at some of the changes, a couple of things that are different from the last time that we spoke. The global public equity portfolio allocation and target. Last time we talked, it was 31%. Now it's 34%, and our portfolio allocation has risen to meet that new target benchmark that began on January 1st, 2016. In reciprocal of that, you can see that the cash has been reduced from 5% down to 2% for our target, which was the impact of moving to that global equity overweight. Another difference that you may see is as real estate, while we have been historically underweight for that catch-22 that we discussed, has been moved to weight. And that's the way that we've taken to public REIT investing, and using that as a lever to really move to weight for our, as it has been our highest performing asset class. Now, as you can see, being at weight will hopefully minimize that allocation effect that has been historically negative over time. And as Brian Moore will be talking to you a little bit later, hopefully adding to the selection effect as well. Now, as far as how those changes have been made, the 3% from cash to global equity has been used or been implemented using the overlay, as well as the public REIT exposure in real estate as well. So you can see the number has increased as far as the green synthetic bar in real estate and public equity since the last time we spoke. A way to show this over time is, as you can see, the light green on the very bottom of the graph, which is our global public equity. You can see the increase there, as well as the implementation of the public passive REIT exposure that we've moved into as of 12/31, showing up over time. So that is, again, how our portfolio has materially changed since the last time we spoke, and how our attempts to add value has played out over the course of the fiscal year.
What is the total percentage of our real estate exposure?
Is it okay if I ask a question, please?
Yes, go ahead, Mr. Gunn.
Hey, thanks. Maybe because I'm on the conference call, but it's difficult. But did I understand you to say that we had reduced our cash to short duration to 2%?
Correct.
Net of the cash that is sitting in service of the overlay, yes.
Okay. Because I keep an eye on that, and my calculation was the cash to short duration as of the other day was like $4 billion. And if you take the overlay at, I don't know what figure you're using now, maybe it was $1 billion or $1.2 billion, I don't think it's that high now. I don't come up with the same calculation, so we'll have to get back with that later. Let me say that, I appreciate the report, and I'm gonna be a little bit out of sequence, but I'm gonna be fast, because I may have to get on the plane here in a minute, you know, how these planes are. I appreciate everything you said, thanks for the report, and, but there has been some added benefit over the lowest benchmark in the country. We still have a plan that's in distress. I'm worried about the liquidity in the next 2 or 3 years. I hope that, like I said, I'll be on the plane in 2 minutes. I hope that there'll be some conversation about this. I do appreciate the hard work of the staff. I know it didn't come across that way, and of the commission. But we have got to acknowledge that even with these changes that have been made, any pat on the back we give ourselves is going to be years down the road. We're getting a lot of credit for the changes that are being made now, you know, and predicted to be made. Those are baked into the 30-year numbers on the actuarial side. They come out in all different sorts of places. And I just want to go back on record that I think we're setting ourselves up for a liquidity issue in the next year or two. And again, I'll get back with Mr. Berg about those how cash and all is being calculated. But I do, somebody's got to say this, and I didn't hear it coming from someone else, so I thought I'd jump in. And that will be all I have to say. Thanks again for the fine report.
I guess, I just want to clarify, what is our total allocation now to real estate? Was it,
Sure. So, as a percentage of real estate, our passive REIT exposure is 13% of that asset class.
No, you're saying how much real estate?
how much, yeah, how
As a
much?
percent of the total.
Yeah,
And
yeah.
overall, our target is 5%, and we are up to 4.9% of the
Okay,
total
but
plan.
the target
in real
is
estate.
5%, and we're up to 4.9,
9%.
so we're almost
Yes.
there.
And that target starts moving higher once we get into next fiscal year again. So,
The 5% will move up
Right.
to,
7%, I believe.
Seven.
Well,
Oh.
really, it's
yeah,
adding
that's,
2% to
okay,
public real
that's what I
estate.
thought.
Yeah,
I just want to clarify that, yeah,
Is the
okay.
distinction there. Yep.
Do you have an estimate of, about how much of the weak performance in the fiscal year to date is related to the strong dollar?
That's a great question.
I think zero.
Yeah.
That's my read on it, is the dollar weakened until June, and then it really, or I'm sorry, strengthens until June, and then really has sort of hit its level there, and that hasn't been a major force this fiscal year.
So if it has an international context, it's just related to the weak performance of markets rather than to currency.
Well, I think where you see the effect of the strong dollar now is starting to be in corporate earnings for companies that are exporters, right? So U.S. goods being harder to sell versus somebody dealing, from a position of strength in a weaker currency. So I think that's part of what you're seeing inside. It's one of the factors that's causing the market to be soft, the U.S. stock market to be softer than it's been, is that cumulative effect of the strong currency starting to subdue forward expectations for corporate earnings.
Thank you.
Any other questions for Jeff? If not,
So it's Mr.
And,
Moore, Mr. Chairman. Mr. Moore's ready to.
all right, so we'll move on to investment recommendation, and Brian Moore will conduct that, please.
Great. Thank you. Good morning. I'm presenting staff's recommendation to hire Center Square to manage the U.S. real estate security strategy for RSIC's inaugural investment into REITs, or real estate investment trusts. I want to first start off by thanking Eric Ravelli, Kevin Matherly, and Alexandra Campbell for their help on this search. While I'm the person giving this presentation today, this was truly a collaboration between both public and private markets. And before moving on, I also wanted to thank Scott Forrest for his help on the operational due diligence. The recommendation to hire Center Square is to manage up to 2.5% of total plan. The 2.5% sizing is less than the 4% that's permitted under the SIOP specialty mandates. The recommended size is directly linked to our anticipated maximum allocation under any scenario before we would seek to identify an additional manager for this allocation. The fee structure noted in this chart is what staff was able to negotiate with the manager, which amounts to a savings of approximately 12 basis points or $300,000 per year versus their standard separate account fees, which were noted in the HEK report. This fee arrangement is very attractive to other active REIT managers and to even some passive ETF implementations. The strategy received a pass from RSIC operational due diligence and a buy rating from Aon Hewitt and will be structured as a separate account at Bank of New York. We believe Center Square it represents an attractive partner based on their consistent investment process, our belief that active management is rewarded in U.S. REITs, that alpha is derived through stock selection, and that Center Square ranks strong in its peer universe. I want to first touch on the investment process in a bit more detail and why we believe Center Square will be a continued strong performer in the U.S. REIT space. Center Square's investment process seeks to understand the true value of the underlying real estate, the development pipeline, and the company's capital structure. These are all things you would expect to pay an active manager to do, but the other component to their process is incorporating the less tangible observations into it. Their process relies on 20 years of history in the REIT space, which I believe gives them a unique insight into the history of executives and management teams. I.e., are they good value creators or are they value destroyers? Are they buyers or sellers in hot markets? Or are they good or bad operators? These are all questions that we internally would consider in hiring one of our private real estate managers, and Center Square happens to be doing that same qualitative assessment at the individual REIT level to identify good assets at an attractive price with a strong management team. The supporting evidence for the next three rationale are better explained on the next few slides. These gauges will provide you with a small window into the work that we've been doing across asset classes. I first want to make mention that Kevin Matherly, sitting back there, is one of our junior analysts in the Analyst Development Program, brought this concept to life. I greatly appreciate his hard work on this initiative. Through this exercise, we found that there are asset classes that reward active management and others that do not. U.S. REITs happen to be an asset class where you really don't want to be investing passively. Let's do a quick example of how to read the gauges and why we want to hire an active manager in U.S. REITs. If you look at the chart up here, excess returns, you'll notice the light blue, and it goes better to, or goes over to more darker blue. These represent quartiles within the universe, or the active management space. The black band represents our benchmark, and the red band, or the red bar, represents where Center Square would rank on this. If you were to invest in the benchmark, you would be investing in a bottom quartile manager. That's not something that we find attractive. If you look across the platform, Center Square ranks vastly better than the benchmark, and even the universe in general performs better than the benchmark across all of these metrics. And so from our standpoint, this was very supportive of why we want to be active in the U.S. REIT space. Moving specifically to look at Center Square in more granular detail, you will notice that the historical results are illustrative of the firm's consistent investment process. The top chart shows the growth of $1 over a 10-year period. Over this 10-year period, the green shows excess return. They've added a cumulative 25% relative to the index. The bottom chart shows the rolling 3-year returns on a monthly basis for the past 10 years. What's important to note on this chart is the red line represents what the index would return, and then the blue dots represent where Center Square would have ranked had the index returned that. What's important to highlight here is if you look at a low return environment, Center Square has massively added value relative to the index. So as we look at Aon Hewitt's expected return for U.S. REITs of 6%, that to me would be a low returning environment. That's an environment where we would expect Center Square to add tremendous value and actually get us a return that I think could help us meet our 7.5%. Moving on to a rolling 3-year information ratio. So information ratio is something that staff considers very important when looking at managers. It measures excess return divided by tracking error relative to a benchmark. Studies have shown that if a manager has an information ratio of 0.5 or higher or greater, which is quite rare, they're considered skilled. It's worthwhile to note that in this chart, every period of the past 10 years on a 3-year basis, the manager has been above 0.5. And if you go back and since the the strategy's inception in 1995, 97% of the rolling 3-year information ratios have been above 0.5. We think that, to us, demonstrates skill that CenterSquare has been able to show here. And then on the bottom chart here shows their attribution. So this is going to cover how they generate their alpha. The red bar shows their selection through stock selection, which we feel is a very sustainable way for managers to add value. CenterSquare acknowledges that sector selection, shown in the blue, is a lever that they can pull, but it's not something that they actively try to make bets on because that causes a wide range of potential outcomes. If you exclude 2009, which happened to be the best performing year on history for CenterSquare, over this 10-year period, they've averaged 200 basis points of excess return annually. And moving on to peer comparisons, while there may be managers that have a higher excess return in any one calendar year, if you smooth those results over 3 years, CenterSquare is consistently ranked at or in or near the top quartile. And you could see where also the benchmark falls on that ranking scale. Moving down to information ratio, which I just covered before, why we think that's important. They are the clear, consistent leader in the space, which I believe really speaks to their consistently applied investment process. While staff believes these are compelling reasons to hire CenterSquare, there are a few considerations I want to draw your attention to. The firm's success is actually very closely tied to U.S. REITs and to REITs in general. 88% of their AUM is through REITs. So total firm AUM, 88% is through REIT strategies. This could pose a risk to the firm should there be a sustained period of underperformance or substantial decline in REIT values. We see this as both actually a pro and a con. We believe it builds a very strong alignment of interest between our investment and the success of their firm. So they're incentivized to continue to grow their process, perform, and evolve. And to further mitigate this risk, we're actually structuring this as a separate account at Bank of New York, so with daily liquidity. So if there was an issue, we could pull our capital back and not be exposed to it. And the second point was the small private real estate footprint. CenterSquare had the smallest private real estate platform of the active managers we looked at. We initially felt, as the search team, we felt that private real estate platforms would be extremely valuable to the overall process, but we didn't really see any material improvement in the returns from those strategies. We feel that the results that CenterSquare has shown hasn't really handcuffed them, so we don't feel that this is actually a large consideration, but then also that this having a large footprint may lead to restrictions on certain securities, which would cause unintended tracking error relative to our benchmark. And also, while I don't think it warrants to be a consideration noted on this slide, I wanted to make the Commission aware that CenterSquare is a wholly owned subsidiary of the Bank of New York Mellon. In closing, staff believes that an investment with CenterSquare represents a high conviction entry into REITs. I'm happy to take any questions that you may have at this time.
Does CenterSquare focus on non-publicly traded REITs versus publicly traded ones?
So their strategy is fully publicly traded, so they're just a publicly traded manager. They have the 12% of AUM that they have that isn't in REITs is actually private real estate, but not private REITs.
Could you talk a little bit of the structure of the separately managed account, how that's structured?
Yeah, so similar to, so instead of like a commingled vehicle where we're sending our cash off and we're exposed to potential lockups or lack of transparency, these are US-based assets that are publicly traded, so anyone could go out there today and buy those. So by structuring within a separate account, we have full transparency with daily liquidity, so we know what the manager is doing, and we can actively monitor risk levels as well to make sure they're not deviating from the strategy. So we actually have a lot of transparency into that. And they could be bought and sold very quickly. And yes, yeah. So this would be we're the only owner of the assets. These would be We could replace the manager if we needed to and appoint Russell. We've done that in the past, to the extent we needed to terminate the manager.
We hold the assets in custody with Boney through the treasurer's office.
No, it's just a flat management fee.
Okay.
We went down both paths with them, but we decided the flat management
So,
fee was
and
actually
we,
more
I
attractive.
assume as part of this agreement, we do have a veto power over the investments or not?
No,
we do
no,
not.
this is, we're outsourcing the decision-making of how they manage, what securities they hold, just like we would with a small cap equity manager or a mid cap equity
All right,
manager.
okay. Any other questions? If not, Mr. Hutchko, you want to read the motion?
Thank you, Mr. Chairman. In regards to the REIT recommendation, Center Square U.S. Real Estate Security Strategy, motion 3, adopt the recommendation of the acting CIO and the Internal Investment Committee as set forth in the summary term chart on page 1 of the due diligence report dated February 25th, 2016, authorize an investment of up to 2.5% of total planned assets into the Center Square U.S. Real Estate Security Strategy through the use of a separately managed account agreement with an anticipated initial investment of $250 million. Authorize the chairman or his designee to negotiate and execute any necessary documents to implement the investment as approved by the commission, 1, upon documented approval for legal sufficiency by RSIC Legal, and 2, upon expiration of the 3-day business review period as approved by the commission on May 1st, 2014, whereas the review period may be amended or superseded by the commission, and authorize the chairman and/or the acting CIO or their designees thereafter authorize the custodian of funds to transfer such funds as are necessary to meet the retirement system trust fund's obligations with respect to the investment.
Is there a motion to approve? Second? Any discussion? All right, hearing none, all those in favor of the motion signify by saying aye. 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 Opposed? None? The motion is approved.
I think he's off the line.
Oh,
You want- make
Mr. Treasurer, are you still on here? I think he
Yeah, I think so.
was catching a plane.
Yeah, I think I had to catch one.
All right.
So it's 4-0. 4-0.
Next item,
Next item would be a motion to go into executive session to discuss investment matters pursuant to SC Code Sections 9-16-80 and 9-16-320, and to receive advice from legal counsel pursuant to SC Code annotated Section 30-4-70A2.
I have that motion. Second? Discussion? None? Then we will go into executive session.